Well, let's go ahead and kick this off. We want to welcome everyone for joining today. This is Hedging 101, Benefits and Risk of Moving to Mandatory Loan Sales for TMC lender members. This is a recorded session, so if you guys want a copy of that, it will be shared with all the registered attendees. And with that, I want to welcome Chris Bennett, our Chairman of Vice Capital Markets with us. Chris, thank you so much for your time today.
Thank you, Mimi. Really appreciate organizing everything and making this opportunity available. So thank you, everybody, so much for joining. Actually, I saw the attendee list growing and growing as we got closer to it. I think this actually was only done in about 2 weeks' notice. So I was especially thrilled to see how many people recognized a lot of names on there that are joining for this. So yeah, thank you very, very much. One thing I'll note as well, this is intended to be really, it's hedging 101. So we're not going to get deep into the weeds on a lot of concepts. We'll save that for hedging 201, 301, 401, and we can always do some graduate level courses down the road too. But this is going to be really a very surface level helicopter view of some of the core components about hedging, why companies do it, how do the core principles work. So that's really what this is going to be about. Now I ask also, if you have any questions during it, what I really want to do is have 20 minutes of webinar and save the last 10 minutes all for Q&A. So if a question pops up, if you would, put it right in the chat while it's kind of fresh on your mind. And then at the end of it, after minute number 20, we'll go ahead and we'll address each of those. Kind of one by one. Some might have gotten resolved, but a number might not have. So, but again, while it's fresh in your mind, go ahead and just stick that right in the chat and we'll get to them all at the end. Again, about me, I'm Chris Bennett. I've been in the industry actually in secondary marketing since 1993, believe it or not. I know I don't look that old. And I founded Vice Capital Markets 25 years ago in 2001, the hedge advisory firm. And more importantly, we joined the Mortgage Collaborative from its very first year. Actually, I think when we joined, there were 6 lenders, so just over 10 years ago. And it's been such a wonderful organization. We've been so proud and glad to be a part of it. Met a lot of great people. So yeah, anyway, I'm really delighted to be here. These are the kind of things that I love to do. I'm going to go ahead and share a screen here. And what this is that I'm going to pull up here, this is actually a white paper put together called Hedging 101. And this is not intended at all to be some canned slide deck anyway. So don't worry that the font's small or you're having trouble reading and it's going fast. In the end, after this webinar, everyone who registered for it will be sent a copy of this so you can take a look at it at your leisure. This is kind of having some nice things to look at besides just having to stare at me for 20 or 30 minutes as we kind of go through this program. So anyway, so let's get right down to it. First of all, what we're going to talk about is what is hedging. Really, it kind of comes down to the what, the why, the who, the how. How does it all work? And what's the path if a company decides to go down the path of beginning to hedge? So let's first take a look at the what. What exactly is hedging? The definition, if you're going to look at it as the word, is a hedge is something that is a financial transaction taking place to minimize or reduce or eliminate the risk of another financial transaction that's taking place. I'm going to give you a couple examples here that aren't mortgage related at all. So think about if you're a farmer and it's currently what it is right now. It's February, we're coming up to March, and you're trying to decide how much corn you want to plant. Do I want to plant corn? I also could convert my field to soybeans or to wheat or to oats. What are the prices of these? And you take a look as the farmer and you say, well, you know what? The price of corn right now is at $5.25 a bushel. I can make 100,000 bushels of that. That would pay the bills and that would work for me. But my danger is come September, if it's a poor harvest or where there's a glut of corn in the market, what if the price isn't $5.25 a bushel, it's $4 a bushel? Now all my calculations go out the window, and not only did I not make $1 million on my farm, I lost $500,000. What am I going to do with that? So as a farmer, what I do is I hedge that. I sell corn futures out in September and October and December so that when my crop comes in, it doesn't matter if the price of corn went down to $3 or up to $7, I can still get that $5.25 a bushel that I budgeted for when I was deciding to plant crop corn in my field. Same thing could be for an oil company is another example. You know that at $55 a barrel, I can make a profit drilling this oil field I have somewhere. But if the price goes down to $45, it's a loser. Just like the farmer, the oil company can sell oil futures and lock in that price. Now, they give up the right and the ability to make more money if the price goes up, but they've made the financial decision that this oil field makes money at this price level, and I want to lock that in. That's essentially what we're doing with companies that hedge using mortgage-backed securities to hedge their mortgage loan pipeline. Hedging all comes into place because as mortgage bankers, whether you're an IMB, whether you're a bank, you're a credit union, what happens is at some point during that application process, you talk to the borrower and you say, here's what we can do. If you were going to borrow this amount, this loan to value, here's your credit score. Here's what we can offer you. It's 6% with 1 point origination. It's 6.5 on a no cost. It's 5.25 on a 5/1 arm paying 1 point. Whatever those terms are, you're making the offer to the borrower. They're agreeing to it. And now you as the lender are on the hook to provide those terms from now until closing, whether it's in 20 days, 40 days, 60 days, whatever that might be. So if you're not hedging, of course, what you're doing, and many of you watching this program are doing this right now, is you lay off that risk by taking a best efforts lock with an investor. It could be an aggregator, somebody like I'll name a couple big names like an AmeriHome or a PennyMac or a US Bank, or maybe it's directly with Fannie Mae or Freddie Mac or the Federal Home Loan Bank that also offer best efforts programs. So by doing this, you've laid off your risk. Now, oftentimes people have it in their heads that, well, I'm best efforts. I'm not taking any risk. Everything is risk free. It's not actually the case. When we take a look and see of all these loans that have been locked best efforts, what percentage of them get funded and purchased at the price they were locked at, the number usually is around 60%. Around 40% of the time, something changed and you don't actually get paid what you thought you were going to get from that best efforts lock. There's another risk that's involved with this too. Let's say you originate a loan, it's intended for sale to XYZ investor. It's locked in at a price of 103. You originate, you underwrite, you close the loan, you deliver it, expecting that 103, and the investor comes back and says, yeah, this doesn't fit our guidelines. We're rejecting this. Sorry, we're going to send it back. Well, now you need to sell to another investor, but unfortunately, interest rates have risen. And now instead of 103, the price of this same loan that you have is 99. So you lost 400 basis points because this lock that you had didn't end up coming to fruition because it was rejected by the investor. So while most of the time when you lock a loan best efforts, you receive that price you're expecting to receive, there are a number of times in which that isn't the case. Not only having to do maintenance with that investor of, I need to the credit score changed or the loan amount changed, or I need to change the rate from 6.25 to 6, or something else happens, the loan gets rejected. There are other things that make best efforts not entirely risk-free. However, it is a way to manage that risk if you don't have a hedging platform set up. Why? Why is hedging essential? What does it do? Why do companies hedge? Pardon me while I get a little drink of coffee here. Sometimes people think, well, the bottom line is just hedging makes more money and that's why you do it. Well, let's look at why that is. It is true that hedging can safely protect margins. The reason for hedging is that you need to be able to manage that risk. If you're not going to pass that off on a best efforts lock, what you need to be able to do is manage the risk in the financial markets so that if interest rates go way up and prices go way down, your company is protected. So the reason that this makes more money is because an investor, whether it's an agency, an aggregator, anybody, especially an aggregator, but agencies as well, they would pay a lot more money for an asset they know they can buy right now today than for the chance of maybe getting a loan a month or two from now. They know exactly what market prices are for mortgage-backed securities, for the value of servicing, all the other speculative payups, specified payups that are there. They know what that is right now, and they know that I can pay you this on a mandatory delivery for 5 days. I know what that is. If it's a best efforts lock that's 30 and 60 days out, not only is there a time decay in terms of 30-day locks being less of a price than 7-day, 60-day being less than that, but they don't know what it's going to be. They don't know what the market's going to be. They don't know what those payups are going to be. They don't know if they'll even ever see a loan at all. So those are the core drivers of why you can get more money for a short-term mandatory lock right now than for a 30-day, 45, 60-day lock down in the future. There are other benefits to it that a lot of people don't really realize, and a lot of them have to do with operational control and flexibility. When you have a best efforts lock, there's kind of a mentality in the company of this is a PennyMac loan, this is an AmeriHome loan, this is a U.S. Bank loan, this is a Rocket loan. And so every time something needs to happen with this lock along the underwriting process, something changes here. We need a 7-day extension. We need to switch it from a conventional loan to an FHA or from a VA loan to something else. You've got to go back to that investor and say, all right, well, what are your policies? What can I do? Now I have to go back to the borrower and say, well, sorry, I know this changed here. So your price is worse by 30 basis points. You need to bring this to the closing table. And of course, most borrowers say, I'm sorry, what are you talking about? So when you're hedging, now instead of being AmeriHome's policy or Chase's policy or another investor's policies, they're your policies. And what you end up doing with the loan after it closes is your business. So there's a whole mentality change that comes, it's a benefit of hedging, of knowing that I'm ABC Bank, and this is an ABC Bank's loan. We're going to use our policies for extensions, for relocks, for if there's a case where, this happens, of course, during the process of underwriting and processing the loan, interest rates drop, people hear about it and say, hey, I heard rates have dropped. I've been calling around and I got a quarter better somewhere down the road. I need you to at least give me partway there, or I'm going to start the process over somewhere else. So what do you do to make sure you can maintain that borrower and maintain that loan? So there are a number of other benefits to hedging just besides that core of whether people quote 20 basis points or 30 basis points or 40 basis points or whatever it ends up being in the value of selling a closed loan right now and what the price is for a best efforts lock that's a month or possibly 2 months down the road. Who should hedge? There's a lot of, it's a misconception out there that hedging is really only for very large firms or even for mid-sized and mid-large firms. I can tell you of the clients that we work with, some are hundreds of millions or even billions a month, and some literally are 5 million a month or sometimes even a little bit less. There used to be kind of an old adage of, well, it takes 10 million a month for it to really make economic sense to hedge. That isn't necessarily the case. Certainly, if you're at 10 million a month or more, it's a really easy one to show the economic benefit of. But there's a number of folks that even that we work with that we see where maybe they were doing that in the past and now they're not anymore. But not only the economic benefits there, but all those other benefits I talked about earlier in terms of flexibility, having it be your loan and not having to go back to an investor and say, now what can we do with this? That those really kind of push it over the line to still being an important part of their company's overall risk management profile. So again, it's not just for large lenders. Sometimes you can kind of take a look and say, well, solve by inspection. Most very small lenders are going flow best efforts. Most mid and large size lenders do things on a mandatory and hedge, but it doesn't necessarily mean that one is better than the other. Different things are different for different people. There's a lot of reasons where hedging makes a lot of sense. Your company might not be big enough for it to make sense. You might not be structured in a way where it makes sense. If your company is structured in a way where every loan officer is their own mini secondary marketing department and wants to do their own thing and kind of acts like a broker, well, hedging isn't going to really work for you until you've actually made some cultural changes and decided to centralize those things and take care of those things in-house as opposed to having every loan officer act kind of as their own individual broker. So there are some things, if you want to make the move to hedging, that you have to take a look at as a company to find out what kind of things do we need to change, what kind of things do we need to put in process for this to be able to be a goal that we can reach down the road. How does hedging work? Just like I talked about with the farmer and with the oil company of selling those contracts out in the future, that's what we do in mortgage-backed securities. So every single one of these loans that we're originating, whether it's Fannie or Freddie loan, FHA, VA, rural development, Section 184 loans, things that are non-QM even, that aren't going directly to the agencies, those eventually are going to go into private label securities. So all of these loans that are being hedged are all going to go into a security. And so especially when we're talking about things that are conventional agency loans and government agency loans, we can actually trade those very instruments that one day those loans are all going to become a part of. It's a very liquid market. Right now, almost all of them trade on something called TradeWeb. And while as originators, we originate $2 or $3 billion a day in these mortgages, on the platforms, they actually trade about $200 to $300 billion of mortgage-backed securities each and every day. It's a very, very liquid market. It's used by lots of participants, and they make very safe and effective hedges. So what we do then, as locks are coming in, one of the most important things in hedging is having very accurate models that predict the percentage chance of each one of these locks coming in. And it's not a static number. It's not like, well, here's a model for IMBs, and here's a model for credit unions, and here's a model for wholesale, and here's one for retail commercial banks. Every single lender is different. And so what you have to do is do the actual work and have a model specifically built out for you and your own historical experiences for every given degree of market movement. There's a ton of things that go into it. So again, gets beyond the surface level of hedging 101, but there's a ton of things that go into it. A big thing that goes into it is how far are you along that process? Are you moving along in step with time, or have you become derailed along that process? If you don't know how your pipeline is going to perform from a pull-through perspective, you're really kind of guessing at hedging. So that's very important. It's important to have good pricing data and to know where are the liquid mortgage-backed securities. There's a number of loans that you can hedge, but you wouldn't want to use the mortgage-backed security that corresponds to it. If it's an 8% loan, you don't want to use a 7% mortgage-backed security because they're very illiquid, in which case you want to cross-hedge it with a different one. So it's important to have good software that shows you how all these line up, how all of them weight, and what exactly happens today if the market rallies or the market tanks. So it's very important to have very good software performing the analytics so that you can make proper decisions, or have a hedge advisory firm like Vice Capital to help make those decisions to keep your risk protected. So during the process, while locks are coming in, they're being hedged. In the end, they either close or they don't close, they fall out. And now it's time for sale. So now these loans can be put out to the best execution, whether that's going direct to Fannie or Freddie, or forming a Ginnie Mae security, or bidding them out to a number of aggregators, some of those names that we talked about here, or maybe pitting them all against each other. Now that you have closed loan assets that you know are available for sale for immediate delivery, you can get the very best bids on them, hit all those, and then remove your hedges against it. So what the hedges have done is protected you. If prices have gone down, your hedges will go up in value because they're shorts. If prices go up, your hedges will go down in value, again, because they're shorts. The whole idea behind it is not reading the tea leaves and figuring out if the market's going to rally or the market's going to tank or interest rates go up or down, but making it so that regardless of what happens to interest rates, regardless of what happens to prices, your company is protected because the gain or loss on your hedge will offset the additional gain or loss on the value of your loans. And the net of what you pick up is the difference between selling a known asset right now today and maybe having a closed loan in 30 days or 60 days that somebody's not going to pay nearly as aggressive of a price for. Getting started with it. The core things you need to have we usually like to use 2.5 million for a net worth requirement. For depositories, obviously it's complete non-issue. There's some flexibility there, but that's the Fannie Freddie net worth requirement. And even if you're not going for Fannie or Freddie approval, a lot of investors are looking for a number there. If you've got something below that and a lot of it's cash, there's a lot that can be made work to be able to stretch and get that done. You've got to have a robust loan origination system with accurate data. Again, this isn't a case where you've got individual loan officers acting as brokers. You've got to have a good loan origination system. You have to have good, consistent data. Partnerships with broker dealers, with investors that are going to buy things on a mandatory basis. These are things we can help out with as well. Those are things that take a little bit of time to set up. Not a whole lot of time, maybe 30 days, 60 days, absolute tops. And human capital, you've got to make sure you've got one or more people that can properly manage that, whether you're going to do that in-house, outsource part of it, or have it taken up by a number of different people. We see sometimes where someone's taking care of the lock aspect of it. Some of the other parts report to the CFO. Some things are done by the controller. There's a lot of different kind of ways that you can structure it internally, but making sure that you've got people inside that are going to provide those resources to be able to help properly manage it. And what happens when you finally, I get this question all the time. All right, we've done all the prep work. We're ready to go. Chris, what happens on day one of hedging? Actually, all that happens on day one is you just don't lock your lock's best efforts that day. They're locked in your loan origination system. All the data's in there, and now hedges will be taken out and they'll appear in all your reporting. Really, what happens on day one is it's not. It can be, you can shoot off fireworks if you want to, but all that happens is you just actually don't turn around and counterlock those loans with investors. They'll be hedged, and then 15, 30, 45, 60 days down the road, they'll be closed and available for sale to those same investors, or possibly some new ones you can make markets in for additional gains, while keeping the company nice and protected. So that's really kind of that is the main part of it. If I sum it up, it's centralize, strengthen, make sure your data is proper, building broker-dealer relationships. Again, a hedge advisory firm like Vice Capital can help with that. Requesting mandatory delivery approval. Benchmarking some of your practices. One of the nice advantages of a huge advantage with the mortgage collaborative for sure, but another advantage of working with a hedge advisory firm is you can get information as to how lots of different companies do things. The collab lab that TMC has, I mean, every lender that I talk to that's part of them find them absolutely invaluable. And that's another resource that you can lean on a hedge advisory firm like us for, is to find out what are other people doing, what are some pitfalls that you've seen, so that you can kind of avoid those yourself and lean on some best practices. And that's also part of the part that talks about engage. So I want to make sure we can get to any questions that have been posed in the chat. If there's some new ones, please put them in there. There's one other thing that I want to show here, and that, if it lets me get over to it, is, sorry, one second here. I've got to move this. I had one other sheet up that I want to show you. There we go. Execution flow chart. This shows how things flow. And again, we'll send this out to you after the webinar. So don't worry if you don't want to kind of read every single piece in there right now. It shows this basic difference in flow chart between what happens best efforts and what happens when a loan is hedged. So again, the main difference is at application, or when the loan is locked, best efforts, it's locked with an investor. When it's hedged, it's not. All the information in your loan origination system, it shows in those position reports. Hedges are put on, they're managed. And then when the lock is closed, when it's best efforts, it's delivered to that original investor. When it's closed and it's a hedged loan, then it's being put out essentially for auction to all your different investor choices that you have within the bounds that you want to have set. There might be some investors that you want to lean toward, you want to lean against based on some operational efficiencies or some other things that are strategic. But that's the main difference. From a loan delivery standpoint, it actually happens the exact same way. Either way, you're delivering a closed loan. In one case, it's been locked and hedged the entire time. The other, it's been locked, counterlocked with an investor, and then delivered once it's closed. So that's kind of when people talk about what are the main differences in flow between the two. This is kind of a nice little flow chart we put that shows how one is different from the other. But when it comes to delivery and post-closing and a lot of those things, they're really identical between the two things. So yes, what do we have that's going on so far in the chat? I want to make sure to save some time for Q&A. So what do we have so far in there? Let's take a look. And anybody else that has them that's popped up, whether it was something from earlier in the conversation or something more recently, please go ahead and put something in the chat and we'll get right to it.
Well, Chris, you definitely make hedging sound a little less daunting when you break it down like that. So we appreciate that. And with the help with Vice Capital Markets also, it makes it less scary to do the transition too. So thanks for breaking that down.
Yeah,
You
no,
must
I
have done a
appreciate
really
that.
good job. There's no
Well, thank you. No,
questions so far.
I'll since we don't have any questions that are yet in the chat, if somebody comes up with something, please throw it out there. One thing that it's come up recently that I thought I'd throw out there when people talk about, well, what are the downsides? It's really one of those things people think, well, hedging is risky, isn't it? Well, not hedging is risky. If you're laying things off on a best efforts flow basis, that's great. But the whole purpose of hedging is to manage that risk. Like I talked about, we're not making more money by how we hedge, but by hedging properly, you're protecting the company from risk so you can make those additional gains that you were attempting to make with a hedging program. Maybe you end up putting that through into the primary market, into your salespeople to actually drive business higher at the same margins, or maybe you're looking to increase margins. That way, when you have cases where you need to skinny up a little bit because you have very competitive situations, you've got the ability to do that. We can even, more and more companies now, especially as we've seen some very large lenders accumulate a lot of servicing. There's a number of lenders, especially depositories, but IMBs as well, that they're kind of leery of, hey, if I sell my loan to so-and-so, I kind of feel like I'm selling my borrower and it's up to me to try to earn their business back. I'm a little concerned there. And we're seeing more and more companies that are interested in servicing loans. And saying, I want to make sure I view this as this is an income stream I want to be able to have. There's a lot of folks that when interest rates shot way up, originations went way down, and there are a lot of companies that were really struggling with their P&L. Those companies that had servicing and had this nice steady income stream coming in didn't have to make rash decisions because that was the cushion that helped them get through more difficult times. And actually, advice, we actually hedge servicing. So there's a concern sometimes that, well, I built up this big servicing book, and if interest rates go down, what if those loans pay off? We can actually hedge against that risk. And a lot of the biggest companies will do just exactly that, so that if interest rates do go down, their servicing hedge pays the money that makes up for the amount of servicing that ran off for them. Since we don't have anything, there's two more points I'll bring up during the 4 minutes we have. We actually had this happen about a week or so ago. Someone we were talking to that was interested in moving toward hedging, and they talked to their account exec at one of their primary investors. Said, "Hey, we're thinking about doing this. I know you guys are really big on that, so just wanted to give you a heads up." And their account exec said to them, "Oh no, you don't want to do that. Yeah, nobody's doing that anymore. AI is gonna take over all this at time of lock, and so we don't really see anybody going to mandatory anymore," which was really surprising. But one thing that's also true is with a lot of investors, because the investor makes a lot more money on a best efforts lock than on a mandatory, the commission structure often is different. Usually you get double the commission if you work for an investor on a best efforts lock than a mandatory. So there's a little bit of there's an incentive anyway is behind an account exec, anybody looking out for their own best interest. If something's working well for you and you're getting good market share, you don't really want to see that changed. Again, solved by inspection. Medium and big size lenders that have the ability to do it are going out there and they're hedging and they're making those extra gains. A lot of times they're pushing it forward to the salespeople, and they're able to actually compete more effectively as a result of it. So those are one things I kind of put out there too. It's good to talk to people about these. But understand sometimes when you hear something, you have to take it sometimes a little bit with a grain of salt, because everybody's experiences are a little different and everyone's incentives are a little different as well.
Absolutely. So, Chris, if they have a question afterwards, can I put your email out here so people can reach
Please
out to
do.
you
Yeah.
directly?
Yeah, absolutely. Please do email anytime. Actually, anybody who's going out to the conference in Scottsdale, if you'd like to spend some time to get together, I would absolutely love that. Please let me know. Actually, I've got a dinner. Actually, I'm hosting within a walking distance of the hotel on Monday night. Mimi's going to be at, and we've got one or two open spots actually. So, anybody watching this, if you're coming to Scottsdale and you're hungry on Monday, let me know today. Let me know tomorrow. For those fill up, and would absolutely love to be able to meet you. Join us for dinner, and yeah, have some great discussions. But would absolutely love that for anybody who's actually going out to Scottsdale, which hopefully a lot of people are.
Yeah, we're excited and we look forward to it. Chris, thank you so much for your time today and for sharing these intels with us. I did put Chris's email address on chat, so if anybody's interested, please take that down. We will be sharing a copy of this recording with everyone who is registered today, so thank you for joining us. And Chris, I look forward to seeing you in a few short days.
Yeah, same here. Hey, thanks so much for hosting, Mimi, and thanks everybody so much for joining.
Bye, guys.